Good afternoon, everyone. Welcome to our fifth webinar on capital markets, which is being organized by Asian Development Bank Pakistan's office, as well as KASB Securities. This webinar is on derivatives and risk management, lessons from global market, and we have with us two experts from London joining us from the UK to discuss about risk management and derivatives. We're also joined by a number of players from the regulators as well as the stock market. So over to you, Ali, for introduction on the topic and to our speakers today. Thank you.
Thank you, Sana. Delighted to have Shamyl and Omer here for this webinar on derivatives and risk management. Derivatives is an area which is kind of missing in Pakistan's financial market, and it has been and is a part of the plans in terms of the roadmap for capital markets development. And I think it's an essential part of that. So I'm really delighted that Shamyl and Omer have taken the time today to talk to us. Both of them originally from Pakistan, from Islamabad, and Rawalpindi, have more than collectively 40 years of experience in financial markets at top places such as UBS, Citigroup, Goldman Sachs, SocGen. Now they are founders of a hedge fund, Westridge Capital Markets, which is based in London. And they have depth of experience in trading various kinds of derivatives products, ranging from equities, emerging markets, to commodities, to financial derivatives. So with that, over to you, Shamyl and Omer. Would be great if you can provide us with more background about what you have done, some of the lessons and insights which you have seen from trading in the instruments, and guide us through a bit about how these markets work, how they manage risk, and especially how technology now plays a big role in these markets. And I ask that in particular because I'm aware that your fund is a tech-based fund and you have developed an end-to-end technology stack which you guys use to trade cross assets globally. And because I think there could be lessons for that for Pakistan in terms of how can we modernize our systems, our capital markets, our expertise, to not only introduce derivatives effectively, but also do risk management prudently on that. So with that, over to you. The format of this call would be after your presentation will be up for Q&A. And for those who want to ask questions, please write it on chat. Or if you want, please raise your hand and I can unmute you. So with that, over to you, Shamyl and Omer. Thank you.
Thank you very much, Ali. Thank you, Sana, for organizing this. I congratulate you on doing such topical debates and topical discussions. You provided a bit of a background. What I'll do is I'll provide a bit more background on myself and introduce Omer also, and then Omer can talk about his background. We can talk about our firm, how it started, where we're at right now, and then I'm sure there'll be lessons in where we're at right now and how we got here. And then we can absolutely, like you said, answer any questions that you have. So in terms of background, both Omer and myself are from Pakistan. We did our graduate studies at Oxford in 2000, 2001. And after that, I was at the IMF for a brief period of time as an economist. And then I joined Lehman Brothers as a derivatives trader, both in New York and in London. And when I joined the market was fairly manual, and people would run around, with tickets in their hands when trades were executed. And throughout that 20-year period that I was in the markets, we went from a market that was fairly manual and hybrid kind of trading to fully technology enabled and very electronified. So after Lehman, I joined Citibank, and at Citi, I was running electronic trading for emerging markets. And after Citibank, I was at Morgan Stanley running their European electronic markets business. Throughout that time, I was a derivatives trader. Derivatives form, as you know, the largest part of the market. So, if you had to put some quantums on the numbers, if the core market trades at X, the derivative markets is 15 to 20X of that. And within derivatives, I was fortunate enough to trade foreign exchange. Foreign exchange is the largest market in the world, as you guys are aware. It trades, believe it or not, $5 trillion a day. It trades between $5 trillion and $6 trillion a day. And within the FX market, 2 trillion. So 1/3 is spot, which is the non-derivative part of the market, and 2/3 is the derivatives market, which is so 4 trillion a day of derivatives, including forwards, options, futures, swaps. That's for trades. So, like you rightly pointed out, derivatives are the most important part of the market, and over the time that we were in the markets, we discovered how important they were, and they became more and more important with every passing month, year, and decade. So, just to give you some indication of what we saw in the markets, why derivatives are important over the course of my career, they add transparency to the overall market. So it allows more players to come in. They can put margin and trade bigger sizes. They allow people to have leverage. It allows people more market efficiency also, because derivatives on occasion allow arbitrage opportunities. So if you have derivatives, it takes out arbitrage. And because derivatives are a more sophisticated version of the markets, it also allows an increase in the level of, or the caliber of human resource that comes into the capital market. So when we joined, there were people in the markets who had never gone to university. But with the development of derivatives in the market and more technological advancements and more sophistication in the market, we noticed more PhDs and more educated people come into the trading aspect of markets. And for any emerging market, it's a very important aspect because it just highlights and just improves the overall workforce in the capital markets also. So we can then talk more about our particular firm and what we've done. But before that, what I would like to do is just introduce Omer. And Omer is a PhD from Oxford and my partner in this business, and we've been childhood buddies. So maybe give him an opportunity to talk about his background, and then we can come back to our firm and move on to our journey within derivatives and technology.
Hi, so my
Well, I think you can speak now. You are on
yeah.
mute. So there is interference because you are in the same room. Yes.
You could out as well. Yeah. Okay, so
maybe Ali, can you just move me out?
Actually, hold on.
Shamyl bhai, you just have to unmute yourself. Okay, great. Thank you.
Sorry for that, gents. Can you see me on Shamyl's screen now? Fine.
Yes, we can.
Okay. So my background, as Shamyl briefly alluded to, is quite similar to his own. And we were together doing our graduate studies at Oxford, and then I joined the markets about the same time, both joining Lehman Brothers. So I've always been a derivatives trader since that time. And obviously my educational background was very, I should say, started with very technical, getting to fairly technical, but kind of remained in the computer science, mathematics, computational domain throughout till I joined the markets with Lehman Brothers as a quantitative researcher in the foreign exchange derivatives on the foreign exchange derivatives desk, and from there on I changed my trade a little bit to a foreign exchange derivatives trader, and then spent the good part of the last 20 years trading FX derivatives, mainly options and forwards options, and then some exotic derivatives too. So I was at Lehman, then Shamyl and I were overlapped at Citi, where I was doing the electronic market making in options, while when he was running the emerging markets business. And then I joined Goldman Sachs, where I was running the European foreign exchange derivatives business for Goldman before starting off on our current journey, which is our firm. So I think Shamyl's touched upon the uses of, why derivatives are so important. I just make a couple of points to second that. And I think it's the purpose of the derivatives, as it says, significantly bigger than the underlying market, actually provide a lot of very good functions, even though after 2008 in particular, sometimes derivatives have had some bad press because obviously provide a lot of leverage to the market, which in the wrong hands can be a bad thing too. But the truth is that that handled well, they are an extremely useful tool, which is why post 2008, if anything, you see further development and increase in the derivatives market space. So they provide a very important risk management tool. The price discovery becomes much more transparent, and both for speculation and for hedging, the cost of trading goes much lower because they're significantly cheaper than trading margin. Simply the point is that derivatives or futures in particular, for example, are a margin product which eliminate the need for the borrowing that needs to happen if you trade on margin. And so it's a significantly lower funding product for all market participants. And then sometimes the derivatives are just are important because the underlying cannot easily be created. So if you have an index future, for example, it's significantly easier than trading the underlying basket, even if it's through an ETF, because the future just gives you instantaneous exposure, both long and short, to the entire basket. Whereas shorting that basket through margin would be a very difficult exercise, and sometimes it's not. From a regulatory perspective, it's not even allowed. So, for example, in India, you've got futures on individual stocks, which are not very common in the Western markets. But because there is no, most of the time, shorting stock is either not allowed or is very difficult. So the futures actually provide that risk management tool, in particular to the market makers who need to hedge their exposures all the time. So all in all, I think any developed market just absolutely needs to have a significant derivatives portion right now. Without that, I don't think you can develop an electronic market in the modern times. It's pretty much impossible from the experience of all the developed and also the large developing markets now. So I'll hand it back to Shamyl to talk about our firm, and then we'll go from there and maybe take on questions.
Thank you, Omer. So while I start talking about the firm, we've got an interesting slide we want to show you. What we'll do is we'll try and make that available also as we start this conversation into our firm. So about 2.5 years ago, Omer and I joined forces again after he left Goldman and I left Morgan Stanley to set up our own firm, which was going to be a technology-enabled trading firm. And we have our own hedge fund that trades cross-asset on the global markets. Over the last 20 years, what we'd noticed was that more and more, as I said in my opening stance, things were moving from a manual-driven model to a technology model. So, if you think about the number of technologists and developers that large financial institutions are now hiring, it's, for smaller technology firms, it's actually more than that. There are more technologists being hired by Goldman, Morgan Stanley than there are by small technology firms here in London and Europe. So when we started our journey, it took us about 9 to 10 months to actually build this technology ourselves. So both, all three of us who are the founders of this firm have a technology/trading background. So it took us about 9 to 10 months to build the technology stack. It's a complete end-to-end stack where we do our testing of the models and execution of the models and risk management on the same Java stack that we've got. It's very sophisticated, high-end Java that we run this on. And it's not the first time we've done it. The reason why we know how to do it or we're good at it is because all three of us had done this twice before, once at Citibank, once at Morgan Stanley, and we decided to do it for ourselves this time around. The more we talk about derivatives and the more we talk about transparency, I think it's very important to also talk about risk management because, as all of you are aware, derivatives do carry bigger risk than just trading the underlying, both in terms of just being more volatile, being a leverage product. So where it has its advantages, has disadvantages also in terms of the risk-taking side of it. And so risk management using technology is the key. And we are a 10-man team here, and we believe that the best technologies in the world are built by small groups of people. So we've got an infrastructure which is about 4 million lines of code now, built by a very small group of people. So generally, it's not a good idea to outsource or vendor these things to large firms, because you don't get the attention to detail, you don't get the personalized service and so on. So at this moment in time, on a 24-hour basis, our fund runs completely seamlessly without any manual intervention. Whether we trade foreign exchange, or we trade commodity futures, or we do some equities, not much, nothing is manual trading or any manual intervention. Everything is done automatically, systematically, and without any discretion. So the models run on their own. The only discretion involved is when we are building our models. So before we have an intuition, we build our models, and then that's when it all goes electronic and systematic. So that's our side of the firm. And what we've done, we've just basically implemented everything that we learned over the last 40 years, combined 40 years of being in the market, and implemented it in our own firm. And I think it's a good base case or good test case for a large market to think about similar kind of issues. Maybe we can show the presentation, the slide.
Sure. You can share your screen. Yes.
Yeah.
You are the host, so you can share your screen.
And I thought Omer was going to.
Omer is also the host, so he can also do it if you want to.
Okay.
You want me to do it? Yeah.
Okay, brilliant. So, this is essentially what we trade and how we build the technology stack from start to finish. I think I've alluded to some of these things, but if you wanted to share this, Ali, without the research process bit later on, you could make this available. It all starts with the hardware. So you need the best hardware infrastructure to do this. So you think about our office, we're a 15-man office here in London, but none of our systems are in the office. Everything runs from data centers. We have data centers in New York, we have data centers in London and in Singapore. So, we try and cover the global market by being in those different data centers. So God forbid if something happened to this building, our systems are still running in those data centers. So for example, in the last 4 months, because of COVID, we weren't coming into the office, but, there was absolutely no change in the way our business was running, because the 3 main data centers around the world, one is called LD4, London, NY4, New York, and SG2, Singapore. That's where all the large financial institutions are. And someone like us that's running a niche hedge fund could also be in those data centers. So once you're in the data center, you're basically catered for by the infrastructure there. You just need your own infrastructure to run your systems. That's what we've got. And that's pretty much the key to everything. Then a lot of times, going back to transparency, electronification, and technology, connectivity and execution is key. So if you think about any exchange, if you're well connected to them, they have a strong infrastructure. We can easily, as traders or market makers, we can easily connect to those exchanges. What are we worried about as a trader or a market maker? We're worried about robustness. We're worried about stableness of the system that we are connecting ourselves to. So our system is very robust. We know that because we built it. We have an option of trading on 20 different exchanges. We only trade on 7 different exchanges. Why do we only trade on 7? Because they're the ones that have the most robust technology. I can control my technology stack. I can't control the exchange's technology stack. So I really need us and them to be on the same wavelength to make sure that there are no missed trades, there are no false executions, there are no breaks, there's not an issue where I'm filled on risk that I don't actually have, or I think I've got risk, but I don't actually have it. So all of those situations are really bad for a market maker or a trader. So very key. Then because we trade, this is more specific to us, but becoming more and more specific to the entire market. As I said before, the caliber of people who are coming into this market is much higher. They're coming from a very quantitative background. They're either PhDs or very highly qualified engineers who are coming into the market. For them, you need a very good quantitative development toolkit, whether it's a quantitative development toolkit that you build yourself or is something which is inherent and more, native to the exchange. It's a key part in anything that we do or anything that's being done by the market now because of its electronification. Then I think, there's no coincidence that the most important piece of all of this forms the center of that technology stack. It's the risk control and systems. As soon as you take out manual intervention and as soon as you take out discretion from any market or any system, you need precise, very strong risk controls and systems. At any one point in time, we aren't the largest hedge fund out there. We're actually, mid-tiered hedge fund, but we could easily be trading. We could easily be trading about $50 billion a day of overall risk. So just to take a step back and talk about what systems we've seen and run before. So Citibank, of the $5 to $6 trillion of FX risk that Citibank does, when Omer and I were there, we were running about 300 billion of that. All of that was being run in one infrastructure. So these are big numbers and big infrastructure, but the only reason these numbers exist is because of technology. So risk controls and systems allow you to take large amounts of risk and be comfortable with that risk. So, most of our guys are based in London. Like I said, our system trades 24 hours a day. FX is a market that trades 24 hours a day. There is no start or stop time in FX. FX is a market that we trade. It starts in Wellington, New Zealand on a Monday morning when it's still Sunday evening in London and ends at Friday, 5 p.m. New York time. So 24 hours a day, 5.5 days a week, this market is running and active. We are in this market 24 hours a day, 5.5 days a week. We need our risk and control systems to be robust enough to be able to deal with anything the market throw our way or running risk on a continuous basis. Then a very important part of all of this is data analytics. Why do you need data analytics? You need data analytics at the start and at the end. So you need it when you need data analytics when you're developing your models, because you're looking at data to come up with intuitions, to come up with regression analysis, to find out where there's an alpha, where there's actual return. And then you need data analytics at the end to see how your models have done, what the market impact was, how well the model was able to predict the next move, whether it was good or bad for the rest of the market or not. That's very important. Then, generally a support system requires on average 20 to 25 people, support staff that deal with middle office and back office ticket execution, looking at tickets, making sure everything is in line with what the system actually traded. What we have, and this is where the market is heading, it's automated ops and intelligence support. So AI driven, so artificial intelligence driven support system that alerts us on mobile phones, on our laptops, across the board. If there are any issues, we get reported on every single trade, every single missed trade, every single filled trade, every single rejected trade. So all of those things can be automated so that you don't have to have 25 to 50 people. You can actually do most of this on an automated basis in a very lean kind of way. And then, finally, the simplest thing is, and I'm sure, at a different time, if any of you are interested, we are more than happy to share with you what we've got from a graphical or a GUI basis. We can show the market in much better ways to what we've seen before in the past. These are ways in which, you can have markets look at technical analysis, do fundamental analysis. All of that can be done on interfaces. So essentially, Ali, I just wanted to make sure that we could share with your users our experience on what we've learned over the last 20 years independently and individually, and applied it to our system. And it can be done with a small group of people also, and it's where the market is headed. So I think with that, I would like to open to questions, but we wanted to just touch upon derivatives, risk management, and technology, and the importance of technology for risk management and the development of derivatives in the market. I hope that's...
Thank you so much. And this is fascinating. And, you said, and I'm just re-quoting you, that technology is essential for scaling up and getting volumes in these markets. So, and what's also interesting for me is that it's not just one aspect of technology, but it's how technology touches every aspect of the trade, starting from the hardware infrastructure and going down to how the customers interact with that. And so it's very, very interesting. And as you said, that global markets who are dealing with those large numbers which you mentioned, they are doing that with actually a very few amount of people, human intervention, because it's the tech platforms which have allowed them to scale their systems to work on uninterrupted on a global 24/7 basis. So I think that's very fascinating. We are open for questions, and the purpose was really to make this interactive, and maybe I can kick off with the first few questions. First, I would love to understand from you, amongst the areas which you've mentioned where tech is being applied, are there certain areas which are more important? I.e., for example, like, is there anything which is far much more critical, which is required as an enabling factor for the rest of the things to happen? So that's the first question. And secondly, from the risk management side, are there tools which are standardized tools which big banks use for risk management of the derivatives products? And the third thing is that you highlighted that increasingly the role of exchanges is becoming like technology companies. So, and I think we see that from at KASB's perspective or a sell side perspective, we see that in their valuations. So now London Stock Exchange does not trade like a financial institution in terms of the multiple which the market gives it is actually a tech multiple. So in your career, did you see this change happen? Did this change happen quickly like a big bang? Or was it incremental that suddenly, there were more tech guys which were being hired and their importance within the organizations became more relevant? And then I know Omer is on the call and he's actually a PhD in physics and computational physics from Oxford, which I remember at the time when I overlapped with him at Oxford, there were very few people who were doing it. So it was a very exotic area, but now it seems that it's a centralized area. So would love to have your comments on these three questions. And then if anybody has questions, please write it on chat or raise your hand. And Shamyl, if I could request you to turn off your screen share so I can see the people asking the questions.
Okay. So we'll just turn off that. Is that good, Ali?
Great, thank you.
Okay, so those were very thoughtful questions as usual, Ali. So let me talk a bit about, we can use Omer as a base case. So like you rightly pointed out, Omer's PhD and qualification is far superior to what people used to have in the financial markets. He is a PhD in physics, but actually his dissertation was in applied mathematics. So he was part of the physics department. So very, very, sophisticated kind of education and an experience to come into the markets. But this is exactly where the market is headed. So, whether you think about, so I think there are many people who are not even in Silicon Valley or going into technology, they're coming into financial markets and quantitative trading. And so it's, very much a technology focused game now, because with derivatives, the market sizes are so massive and the data is huge that you actually need all the technology power in the world that you can muster up to clean that data set, to analyze that data set. So that's actually a core part of what technology brings to the table. And I think then the question was, apart from risk management, you said, because risk management obviously is extremely important and technology is all over the place within risk management, but a very key part that you asked about technology being how it's used in these markets is for market making. So for any market, whether it's an emerging market or a developed market, the most important thing for an exchange, as you rightly know, and as all of you would know, is liquidity. So liquidity provision is something which a market maker can provide. And the more sophisticated a market maker is, the better the technology infrastructure, the market becomes more efficient. It just allows people to feel more comfortable. It's a level playing field. So all of this, the thesis is that you want to get to a point where it's a level playing field, where liquidity is available and the market is efficient. That's how a market goes from, a frontier or a nascent market to a more developed or a more efficient market. And it just makes people more comfortable. People just become more comfortable in a market like that, and they want to participate more. If there is asymmetry of information, so going back to electronification and technology, what it's trying to eradicate is asymmetry of information. You want everyone to have similar information, similar set of information to work from. That's essentially what all of this electronification and technology is allowing you to do. And then obviously, if a guy, just to give you an example, if there's one trader who's watching a stop, right, that's really inefficient. He has to pass the book from one person to the next and say, hey, watch my stop at 100, watch my, all of that can be done by technology. Technology doesn't have emotion. Technology doesn't forget. Technology can have issues, which is why you need good technologists, but it takes the emotion out. It takes the fear out of trading and managing stops. Just to give you an example of how technology can help both risk management and liquidity provision.
Thank you. So we have a couple of questions. So questions from Saad Siddiqui saying, thank you very much for the presentation, very insightful. The first is the future of OTC markets. Large parts of the fixed income and FX markets still trade over the counter. Where do you see this going? And the second question is, what lesson did you learn from real-time stress test during the severe market dislocation of March and April? What limitation or advantages of existing risk management system did it expose?
Actually, those are very good questions. So, let me tackle the second one first. So, bringing up March or April is thank you very much, Saad, for bringing that up. Actually, that actually shows, if you remember the Swiss franc crisis, many things failed when the S&B did what it did. What happened in March and April across the board just showed how resilient the markets have become overall. Even though there was a big crash, but systems were still able to tackle and they were fine with that crash. And, there was a big dislocation in the market. You had a disease that had just come out and the market was selling off, but there weren't issues that we used to have before. And I was actually, while I was thinking about this call, I was thinking about 1994. Nick Leeson got, there was a big market crash and he basically was able to hide his positions and an entire bank went belly up. Now we're trading 50 times the size of the derivatives, or even 100 times the size of the derivatives that were being traded in 1995. We don't see those things. And the reason for that is that overall infrastructures have become in developed markets so robust that they can deal with these things. And actually, what technology allows you to do is it also allows you to harness all the mistakes that have happened before in a short span of time. So just taking the example of March and April, right? It just happened, but a lot of people will learn from those mistakes because of technology. So you don't need to have been in 1995 or in 2008 to actually see how everything reacted to a big move in the market. So even in our system, in our 10-man firm, we can actually play back, not minute by minute, not second by second. We can play back tick by tick. So every single bid and offer in the market in 2008, when the global financial crisis was happening, or when the S&B crisis was happening, we can, in our system, we can play back every single tick. So it's just like a replay, it's a film of the market, and we can figure out how our models would have done, how our technology would have done. So imagine the strength of that and the power of that. You can actually, sitting in 2020, put yourself in 2008 and see how the market would have reacted had this happened right now. So that just means that overall the market is becoming more and more robust. Then Saad, thoughtfully asked about OTC versus exchange. So I think overall exchanges are becoming more and more important. If you think about fixed income and in particular FX is mainly an OTC market. And, of the $6 trillion that it trades on a day, very little, Omer, do you remember, I think it's a very small amount that trades on the exchanges, a very tiny amount.
5% of it on the CME futures thing.
Yes. So, CME futures trade a lot in FX and in fixed income. However, it's still a very tiny portion of the overall market in OTC. But having said that, with counterparty risk and more transparency and people wanting a level playing field, I only see that going one way. Increase in things going on exchange as opposed to just staying OTC, because you want people to be more involved, and it's easier to trade on an exchange than it is on OTC.
I just add to that even after 2008, there was a big push towards the central counterparty clearing systems. Even the OTC derivatives were sent a lot more to, so there was the European directive, and also US laws that forced a lot of the OTC to be, one, disclosed, and two, to be cleared centrally. Because one of the things that people realized after Lehman collapsed was that having these bilateral clearing arrangements can be from a risk perspective quite painful in case the market actually takes a huge tumble, in particular when a default event happens. So while market events can be covered by the margins that are held between in bilateral arrangements through ISDAs, once a default happens, the ISDA is completely sort of out of the window, and now you need to worry about it. So there's a lot that has actually happened in that time, and in fact, London Clearinghouse has been working on ways to clear forwards and options in the foreign exchange area centrally. And while it's actually a very huge undertaking, and so far there hasn't been so much that has been achieved there, but I know this because there's an ex-government partner who now runs LCH's clearing effort in FX, which is traditionally, as Shamyl said, a completely OTC market. So there is a push to take OTC stuff to exchanges, and two, there is a push to, even if they remain OTC, for them to be cleared centrally, so that the counterparty risk can be reduced. And I mean, there's a slight balancing act here, because as stuff gets onto the exchanges, it becomes a lot more commoditized. So OTC, you can do pretty much anything. So, for example, foreign exchange or even equities, OTC derivatives, you can sort of, choose your strike, choose your expiry. You can choose the kind of, barriers or, any kind of one touches, any other exotic element to the derivative to match your risk management needs or liabilities that you have. Whereas once it gets to the exchange, it becomes a lot more commoditized. So you can't actually have these kind of exotic elements in there. But you've got to do a bit of a balancing for those few expiries and few strikes. Then at least the liquidity is significantly higher. So if you got into something and you didn't want it anymore, you can get out much cheaper than an OTC case.
Thank you for that, Shamyl and Omer. We don't have any questions, so I can again take that opportunity. You talked about market making and that being an important requirement. So if a country like Pakistan, for a market such as Pakistan, want to introduce market making, what do you think are the steps and what are the enabling factor? How can they go about it?
Sure. So I think, in my opinion, the two most important things, and in fact, that's the two things that we've spoken about the most on this call of ours, I think, is technology and derivatives. And one would think of derivatives as a separate topic from market making, but actually it's massively interrelated to the market making. So why I say that is what you need for market making. Obviously, traditionally, to make markets, you need players who are well capitalized. That is something that traditional brokerage houses, dealers who use proprietary capital to provide liquidity to the market can become those bases. Now, these guys, even though they have the capital, might not have the know-how. In a very, very old school, non-electronified market, it might not be that hard because they place some orders or they find people who want liquidity, and they'll provide the other side if they feel it's an okay level to charge that spread and be the other side of the trades. But when it gets to electronic market making, the first thing both the market makers and the exchange, as Shamyl alluded to, need to have great technology. So I think first thing is technology. The exchange needs to have all the trading on all the way. I think New York Stock Exchange now has a market cap of about $35 trillion, and that market cap is on the volume basis all going through electronically. So you need an electronic exchange which is dependable, which is going to settle trades well, have them administered, have the back office functionality all automated, all of that. Once you've got that exchange in place, then you need the connectivity, which is either traditionally is FIX, which is a protocol which is used for financial information exchanges, is called. And then again, FIX is a standard, so you need to have your implementation of the standard, and it's the implementations really vary, so you need to have an implementation which is of a pretty high standard to support that market maker. So once you've got the exchange which has the right kind of technology, and then you need both technology vendors and also firms which are willing to invest in technology, because if you think of the largest market makers on New York Stock Exchange, a lot of names that will come up are not the traditional banks. They are the likes of Citadel Securities. They're even going down. There'll be like proprietary trading firms like DRW, Wolverine, guys who you might not really hear of otherwise. But what they are really, really good technology firms. So they started off, call it between 20 and 30 years ago, as pit traders who knew how to market make. And as soon as the markets became a lot more electronified, these are the guys who invested a lot in technology as firms. So while you need the exchange to invest in technology and get the right kind of technology, but then you need players who are proprietary dealers who are willing to invest in technology and become the other side of this equation. Once you've got these guys invested enough in technology, you can also obviously have some technology vendors who will provide some of the technology, at least initially, a generic technology set to a lot of these dealers who don't want to invest in the technology teams and development teams at a point, but can initially acquire technology. Once they have that, I think you've got the two sides ready. Then the other important thing for market making is risk management. And that's why I say the derivative trading or introduction of derivatives is critical to market making. So for example, and in particular, I should say in particular in a developing market like Pakistan. And the reason for that is that, you provided liquidity on a single share, for example, a cement stock. And now you've got that stock in some significant chunk because somebody wanted to offload it. So you got it and you've got it on your book as a dealer, as a market maker. And clearly, in particular in a developing market, you wouldn't be able to sell it immediately, because if you were able to, then this guy wouldn't have actually sold it to you anyway. So if it was that easy to actually sell it, then a market maker wouldn't really be needed. So the fact that the market maker had to intervene, you're not going to be able to sell it, probably not in minutes, sometimes not in hours, possibly not in days. Now, what are you going to do with this exposure? And the way large market makers, and Shamyl and I have done this for years in foreign exchange market, electronic market making. And what large market makers would do is they will look for correlated products. So if I'm given a chunk of euros and so I'm long euros, but I'm short dollars now, what I'm going to do is I'm going to go short something that I feel moves with the euros. So I could sell some pounds, I could sell some Australian dollar, find other things that are going to get me out of my risk in a correlation fashion. So so in that sense, I think derivatives are critical, because what you're going to do as a market maker is you will take your exposure of the market out by selling a future on the entire market, index future. Or even better, if you had a sector future, you're going to sell the sector future to cover that risk. So what you do is essentially you provide liquidity to the market, be it on the bid side or the offer side. This entire process could work the other way too. And then hedge yourself with correlated products, which are very liquid. And these very liquid correlated products are the futures. And then you can start using, similarly, you can start using options, for example, where you, as a market maker, protect yourself against very large moves. And then in the middle, in the small moves, is where you, as a market maker, provide liquidity to the market and make your money by the spread that people are willing to cross. And so you start creating this very healthy ecosystem of market making. So I'd say two things that you need are good technology and derivative products.
Well, thank you so much. And for me, the underlying thing is how important technology seems to be. It almost seems to be critical in terms of developing the financial system. And as you pointed out, not just at the exchange level, but also at the ecosystem, the partners, the vendors, they all need to be speaking the same language in order to enable these kinds of products to be developed effectively. There's a question from Omer, which I suppose you've answered in your question, but in your answer, Omer, but I'll just read it out. He's saying, in the business of market making in derivatives, do you work on inventory-based models or real-time hedge models, where the position taken by market maker is offset by the opposite position in the same or other market or asset classes? For Pakistan, where derivatives are yet to develop to its potential, how do you think a good approach to kickstart? What do you think is a good approach to kickstart? Because from your opinion, it seems to be a vicious cycle.
Sure. Yeah, I think that's a very thoughtful question, and as you said, some of the discussion has already happened. I think it's very important to have a derivatives market in place to do this market making properly and easily. In the absence of derivatives market, obviously you will have to reside to some sort of inventory model because you have to hold inventory, and in a way you're going to, as a market maker, you're going to be a person who's always net, unless you start trading using margin, and we haven't really gone into that, but margin trading on a physical delivery basis can sometimes be a tool that can be, in the wrong hands, be used for market manipulation as well. So it's not something that's ideal. And in the absence of that, as a market maker, you will always be net long inventory. Because, if you think about it, imagine you have $100 million of total capital, you will probably be at any given point invested with at least 20, 30, even $50 million of that capital long the market, so that you can provide the offer side of the market too. So I think, yes, it is a vicious cycle. Where you need derivatives to get this kick-started, and it's important to be able to offload your net long exposure through something, and that will, in the absence of the derivatives market, might be the margin trading. Now, in terms of where to start off, I think one, obviously having the technology is critical, as we all agree. I think the second piece is having a futures, an index derivatives product. So again, very, very sort of superficially looking at, and there's tons of market that we could look at, but India is a bit unique in the sense that they actually have a lot of single stock futures, which is quite interesting, because in the developed markets, most of these single stocks are derivatives, are CFDs, which are traded against brokers. So you don't necessarily have to go to the exchange to actually trade the single stock futures. And also, generally, shorting stock in the developed markets is not that difficult, whereas in India it is. So I think in terms of where to start off, I'd say, and this is where India started off as well, is the first thing they launched was a future on the market index, and then options on the market index. And then third thing is to go after futures on the market sectors. So before you get to single names, I think what you need is futures developed on a market beta, so that the key thing is to be able to take the market risk out of any position, and that you can do through market index and sector futures. So starting point has to be an index future launch, in my opinion.
And there's a follow-up question from Omer, which he's asking that PSX has recently acquired a trading system which is sophisticated. Do you plan to partner with local brokers in Pakistan for market making and in the derivative market?
Yeah, I mean, I think it's absolutely something we could do. I'd probably put Shamyl in front of the screen to see what he thinks. But yes, my short answer is yes.
Thanks, Omer. Those were actually very good questions, both, Amir's first question. I just want to add one thing to that that question actually highlights the vicious cycle of this, because for a market maker who doesn't have in his armory derivatives or maybe technology, he has to eventually resort to wider spreads. Right, he has to just charge more on the bid and more on the offer just to cover the risk of not being able to get out of that risk. That just shows that the overall market suffers if it's not technology enabled and there aren't any derivatives. But coming back to the second question, absolutely, we're always, we have a very soft corner for Pakistan, and we do believe there is a massive opportunity there, because generally for a market maker or a technology enabled firm, anything which is on the frontier or less developed or less sophisticated generally is, you not only provide liquidity to the market, so you're doing a service to the participants, but also it's a very good commercial opportunity. So yeah, we'd always be looking for something, but I think it's more difficult, my last point is more difficult for a firm like ours based in the developed markets to get into an emerging market. And the thing that overcomes all barriers is technology, because it's easiest, it's very difficult to build relationships. You have amazing relationships in Pakistan, built over not years, but decades. For a new participant to add liquidity to the market, the only edge that they've got is not relationship, is technology. So the more technology enabled exchanges in Pakistan are, the more liquidity they will be able to get from technology enabled and sophisticated firms.
No, thank you. That's a great point, which you said, that technology actually connects everybody, and it actually is a bridge builder, because globally people might not be familiar with Pakistan, and not speak the same language, but the technology language might be similar. And we have on this call Jawad Hashmi from Pakistan Stock Exchange, who is working on rolling out the new technology system which they have purchased from China. So there are high expectations from PSX, I suppose, for that. So moving to the next question, we have 9 minutes left. Pakistan currently does offer deliverable single stock futures. How would you rank deliverable versus cash settled single stock futures in terms of risk, cost, and rewards? What should investor be more comfortable investing in, deliverable or cash settled single stock futures?
Sure. So I think the deliverable futures have in some markets, for example, foreign exchange market is largely deliverable. It's OTC, it's deliverable, and there are most of the commodity markets are again deliverable. But you've got to sort of think about what that delivery really means. So, for example, in foreign exchange, it's easy because if I have a euro versus a dollar future and it's deliverable, no problem. End of the day, I have a euro bank account and I have a dollar bank account. Somebody's going to take money out of my euro bank account and put money into my dollar bank account. All of this is completely automated. Really, deliverable is not that different from cash settled, except for the fact that large chunks of, so if you had a future that's expiring in $1 billion, now $1 billion need to be transferred between my euro and dollar bank account. But whereas if it was cash settled, only the difference of, imagine, the trade made $20 million. Now we only need to transfer those $20 million between the two bank accounts. So that differential can mean a lot in some markets. But then in other markets where delivery means, say, we're all aware of how oil futures did recently, and they went negative, and a lot of people for the first time figured out that what the meaning of not having the ability to take delivery in oil is. So similarly, in a lot of other livestock, all of these, imagine any of these features, all of a sudden someone comes and gives you gallons of orange juice because you were long a feature that has expired. So you need to have a place to take delivery. So I think delivery in those markets then becomes a big problem. In the equities market, it's somewhere in the middle. It's not as bad as having to take delivery for oil or orange juice, but at the same time, it's not as easy as taking delivery for some, $100 million, which are just literally some, bank numbers being transferred between the two accounts. Well, you need the central depository comes into play, for example, in case of a physical delivery feature. So that's one thing. And then the other thing, and I think Ali, myself, and Shamyl, were speaking about this a couple of weeks ago, and we're having this conversation about how margin trading potentially works or doesn't work in certain markets. And I think physical delivery derivatives have some of the elements of the margin trading too, because now that, for example, if the market is significantly more open to small markets, particularly, are significantly more open to not necessarily even manipulation, but at least cornering, because if you've got a large position in the derivative, you can do certain things with the underlying, because at the end of the day, everybody needs the underlying to settle the derivative. So I think in that sense, in small markets where the size of the market is not large enough, there can be certain very sort of unintended side effects of physical delivery. And that's why when you think about all large markets, equity markets in the world, pretty much everything is cash settled. Across the world, all single name futures are cash settled. And as I said earlier, lots of single name stuff happens on contract for differences in the West. But even in India, where you have proper futures for single names, they're completely cash settled. Options on single names are cash settled. And then, when you get to indices, there's no other way but to cash settle those futures. So I think in large, there should be a very big bias towards cash settled futures versus physical settled futures. And I can't think of many reasons to have physical settled futures other than some very OTC reasons. So you can have a OTC market in parallel, which is physically settled, because imagine you sell some, in particular, people do these dual currency type investments in private among the high net worth individuals. So it's a very interesting product in the West, where people will effectively sell put options, earn the premium, and then at the end, if the option's exercised, they get the underlying physical. So if you can effectively, it's a way of saying, I'm going to provide a bid for a particular stock 10% below here and earn 1% for providing that bid. At the end of the process, either I will have my cash back and I haven't gotten the stock and I get 1%, or I've got the stock at 10% below price and I also have the 1% yield. So that kind of product can be developed on physical settled options in particular much better. But I think it's a very niche market. In general, the main market making capability that we're thinking about here needs cash settled futures and options.
Thank you. We still have 4 more minutes. Again, I'm taking the opportunity for the questions. In terms of talent, you said, and Shamyl said this earlier, that when you joined initially, Lehman Brothers, at that time, it was still not, it was rare for them to have so many tech people. But gradually with time, you're saying now most of the companies involved are actually tech companies in nature, form, and shape. Did this change happen incrementally, or was there a big bang and suddenly, they said, okay, now let's invest in tech and let's hire people in tech? Because it does seem to me that, without having that cultural change, and or at least even without acknowledging the need for that change, it will be very difficult for introducing derivatives and improving risk management and connecting with global markets and increasing liquidity. All the good stuff we have talked about seem to be impinged by that.
Sure. So I think, in terms of the question, whether it was a big bang or incremental, look, technology by definition has a way, or, sophistication has a way of being incremental, right? So gradually things become more sophisticated, they become, more technologically advanced and so on. But I think a lot of that move of electronification in the markets was driven by regulation because of the need for more transparency and because of the need to level out the playing field. So, as all the stuff that we've talked about, you talk more about market making, you talk more about liquidity provision, you talk more about on-exchange increase in liquidity and on-exchange trading. Everything results in eventually there being some degree of asymmetry of information, right? So whether it's more sophisticated, versus less sophisticated, more knowledgeable versus less knowledgeable. And the way to deal with asymmetry of information is to make everything electronified and make everything technologically advanced. So not just in terms of trading, what we've talked about, but for a bank, if you think about it, if you go back to the example of Nick Leeson in 1995, he was able to hide trades that eventually cost $1.4 billion. And the reason he was able to hide trades was because there wasn't a system to say, look, this trade is there and it's missed, it's not cleared, it's not been tested, it all hasn't been confirmed. There's no confirmation for this trade. Whose trade is this? Who's responsible for it? So a lot of that was because they wanted more scrutiny. Regulators wanted more scrutiny. And it's easier to just share a spreadsheet to say, or an FTP file or a flat file to say, these are the trades of the day. These are the trades of the last 5 minutes. These are the trades of the last 4 weeks. Then to actually provide someone with a file folder to say, these are the confirmations, have a look at them. You need 4 people, 2 hours to look at that. But this way you can track and you can actually, flag errors in seconds.
Thank you. So you said like it's the regulatory push for more transparency and greater disclosure, which was actually the enabling factor for having this. So the final question, again from Omer, he's asking that in Pakistan, risk management for single stock deliverable future is based on VAR methodology, value at risk. Review of other jurisdictions reveal that portfolio-based risk models are more adequate for managing the risk, as they charge higher margin on accounts with higher risk positions as opposed to the same margin based on VAR. What are your thoughts on the risk side?
Sure. So I think, it's a very, again, very, very thoughtful question, and it's very important. I think VAR as a methodology is, in our opinion, actually pretty flawed. Not just for market making, but also when measuring the risk of a proprietary trading firm or a large hedge fund. I think and it's a number of things have been said about it, done about it. It's the reasons are very multifold, but just to give you a flavor, you're always backward looking, and the event that is a very rare event which you're protecting yourself against, by definition doesn't happen that often. So you tend to create a model based on looking at years of data, and if something that hasn't happened in those years all of a sudden doesn't really one, show up on your radar, and two, when it does, you can't recognize it because you're so data driven. So there's got to be some thesis driven risk management ideas to start with. So I think in that sense, I don't particularly rate VAR as a very good risk management tool. I think what he said is extremely pertinent in terms of when you, it brings us to sort of that central counterparty and how exchanges, for example, manage their risks, and how they sort of run insurance funds, for example, for risk management, and those insurance funds are funded in proportion of the amount of risk that a member has taken against that exchange. So the central counterparty has multiple trading members. Obviously, those members are taking on risk positions, so they need to contribute to their own default probability based on the kind of risk that they're taking, and the larger the risk or the more esoteric the risk, the bigger their proportion of contributing to the stability of the system should be. So I think absolutely you should mark risk from different people differently based on their behavior, based on their capital behind that they're holding behind it, the margins that they're holding, the leverage that they're taking. All of those things need to take into account, because same position being long some stock can behave extremely differently if it's held by someone who's going to sell it on a 2% move lower, or the guy who's going to hold it even if it goes 30% lower. The market will behave extremely differently in the two scenarios. So while, for example, post-event, it's quite difficult to really tell what the market would have done, because imagine this guy holds this stock, which he's going to get out of it because he's going to run out of margin in a 5% move. He will end up selling it at the 3% mark, and then that could trigger other sellers, and hence you might see a move which is 15% lower, for example, because someone had to sell at 5%. In the other case, where you had this guy who's not going to sell till 30%, you might not see that 15% move at all, and you'd say market goes down to 10 and then bounces back because nobody's selling. Imagine. So it's a very the framework for the market is made up of multiple agents who are all doing their thing, and the resultant risk in the overall market, which is why I say VAR is a bad framework, because it's very passive. It just looks at statistical numbers in the past and kind of takes away this thought that interaction of the current agents actually make things the way they end up being. So I think risk management tools have to be a lot more sort of designed for individual risk takers. They have to be very mindful of how portfolios behave, and I think understanding not just statistically, but anecdotally, what individual parts of that portfolio are going to do is an extremely important part of risk management.
Great. Thank you, Omer. Thank you, Shamyl, for joining this call and for giving us insights into derivatives, market making, risk, and technology. And for me, the key takeaway from your talk is really on technology and how important it is, and how it's almost necessary for the regulator to push and adopt it from at the exchange level, but not just at that, but also push it through the whole ecosystem on the vendors and the brokers and the funds. From my perspective, I think human resource of that is really important, and I think that's is not trivial task because almost the whole mindset and the whole skill set which currently exists and needs to be changed. And you're right that we did notice that change, and we have seen that change in investment banking in the developed countries, where now JP Morgan very proudly says that we are a technology company and not a bank. But we are yet to see that kind of impetus in Pakistan. But I suppose the silver lining and the hope is that the new technology system which the PSX has purchased and which they will be rolling out hopefully will be able to take us into that direction. So thank you for your time, and I will share the recording of this presentation to the participants, and also on our website, and also the slide which you mentioned. I'll share it to the participants and on the website. So thank you.
Thank you very much for the opportunity. It was absolutely great, and congratulations on another organized talk. And finally, congratulations to the PSX on their new technology system.
Great. Thank you.
Thanks.